This video is the first of a series of videos that discusses the details of the valuation formula used by the Polaris investing website and the inputs to go along with it. So to get into more of the details, I'm using Walgreens as an example. So here's start out with Walgreens as it's shown up on the Polaris website, showing a today of theoretical value of $86.82. I'm looking at here, and so what I want to do is go off and drill down as to where that value of $86.82 is coming from. Before I leave the Polaris site for a while, I want to point out a major input into the valuation formula is the sales growth, which is entered by moving this slider around. Since originally recording this video, two other input sliders have been added for future profit margin and future price earnings multiple. These values used to have to be entered indirectly through the sales growth slider, but now can be entered directly through their own sliders. Other values that go into the formula are shown down here at the bottom that I've covered in other videos. Since this video was originally recorded, the company information section includes more information, particularly the competitive advantage period, also known as Y, and always set to 5 in Polaris, the cost of equity, and future shares. It also restates the default future profit margin and default future PE multiple that are also included in the information associated with the new sliders that have been added, namely up here, this default value for future profit margin and this default value for price earnings multiple. Cost of equity that's now in the company information section has always been displayed here and called the market investment return. Well, let's get into the details. This is a very simple spreadsheet that for Walgreens will calculate the intrinsic value of $86.80. It's the theoretical valuation. Comparing that to $86.82 that's currently shown on the website. The only reason for the slight difference is the input parameters are not quite as precise. They were just manually typed in here, so they're not carried out to 5-6 decimal places like they are on the Polaris website. So over here in column D are the input values along with Y. It's the number of years that you spend in this competitive advantage period, or it could even be a competitive disadvantage period. It's whatever short-term period you feel like the company is going through something that's not necessarily going to be around 5 years out. Again, Polaris assumes 5. There are other values that you need to know, namely what is the current dividend, what are the current sales, and what are current shares. That's more lookup. You go find those somewhere on websites. I will show you how you can find those all on the Polaris website. And then you get down to the slider value. That's why that's in dark gray, because that is the same value that you can enter in on the Polaris website. Then these remaining inputs, these 4 here, and then the number of years and the competitive advantage period, I have to be entered implicitly through the only mechanism you have on the Polaris website is the sales growth slider. As already mentioned, since originally recording this video, you can now explicitly enter the future profit margin and future price earnings multiple through the new sliders that have been added. But that's what I'll briefly be talking about later in this video, and then get into more detail in subsequent videos on valuation that talk in detail about each input parameter and how to think through them and enter them through the use of the sales growth slider. Alright, so let's first of all talk about the formula itself. I've talked in previous videos that basically discounted cash flow is near-term cash flows, present value, added to some eventual stable period in which you calculate a terminal value for, and then discount that back to the present. You can do it with explicit cash flows in the first near term Or you can use this relatively complicated formula that exactly accounts for the growing of dividends in the near term. Polaris uses this simplified formula, which is the dividend times the number of years that you believe that this competitive advantage period is for. And then the second half is pretty straightforward. You just take current sales times some growth you assume in those sales for the first, let's say, 5 years, then multiply it by a profit margin to get earnings, company-wide earnings in the future. Divided by the expected future outstanding shares. And that's the earnings per share. Take it times a mean reverted PE, and that's a price in the future, and then discount it back to get a present value. That is shown over here in this graph. The red dot would essentially be the future value that you calculate by adding the dividend and not discounting back, but just using the future value price that you calculate. And then the purple is just connecting back to the current price, and then it would say that Polaris is assuming that this over time the market will travel this purple line up to the forecasted future valuation 5 years out. Now the orange line represents present value, and if you just discount by, in this case, 7.8% year over year, you'll back it up to a theoretical present value of $86.80. All right, so that's basics of the formula. Let's go look at in the spreadsheet how things are actually done. So present value of dividends, that's the first part. And you can see here in the formula, it just takes Y times the dividend, the most recorded dividend, which is here, which is a lookup value. Where you go see that on the Polaris website is that you could look at here and see that dividend yield is 2.65%. Multiply it by the current price, and that would be roughly the value that was used when the spreadsheet was created. Current sales, go to this Polaris website, come down here in the graph, you just look at time zero. This is the sales graph, and that shows you what current sales is. And then current shares, if you're going to use the Polaris website, you do have to back into it, where it gives you future shares, and it gives you what it believes over the next 5 years will be the share trend. So you can back it up by taking this to the fifth power, dividing future shares by that number, and it'll give you the current shares. Or you can go look it up on numerous websites to see what current shares is. All right, so that's where those three things would, you look those up and enter those in here in the spreadsheet. And then the sales growth, well, let's compare to, I'm using the same default sales growth that Polaris uses when you bring up Walgreens. Share growth, I already showed you that at the bottom of the site that's been defaulted to. The profit margin was 3.5. The future price earnings multiple is 14.1. Cost of capital, 7.8. If you go out to here, you see it's 8.0, so it's just been rounded up. All right, so intermediate calculations that are done to come up with the eventual theoretical valuation. 5 times, I already showed you that, 5 times the dividend. Future sales, this is simply your projected sales growth for the next 5 years times current sales. Future shares is projected share growth times the current shares. And then you can calculate this intermediate result of future earnings per share. That's a pretty key number, so I bolded it. And where that comes from, again, is current sales, grow it for 5 years, take it times the profit margin, get earnings for the company, divide it by future shares, and that's your future earnings per share. So when you look at the calculations for earnings per share, it's pretty straightforward. All right, then we want to calculate a future price. So you multiply by the future price earnings multiple. And then you get a future value. You add that price and the present value. Now, a future value really should, the dividends will grow a little bit over the next 5 years from year in and year out, and they get reinvested. So it's not totally accurate, but for this kind of a valuation where we're just trying to get a rough idea, kind of a range, and eventually moving the slider sales growth slider on the website, moving that around a little bit, you're really looking for kind of a range. So this is more than very appropriate to use this kind of approximation when you're just looking for a kind of a range of what value could potentially be. All right, I'm going to go back to the graph for a second, and you will notice that the blue line here at the top represents the theoretical valuation, and when I discount it back, I get the actual $86.80. The red dot represents what you as the investor would forecast for a future price that you would target is actually coming from the practical valuation. Now on the website you only see the present value of that practical 83.84. So that's really back here, right where this yellow line is, 83.84. But the way that you move from a theoretical valuation to a future value of about $121 and then a present value of $83 and something, that's based on proprietary algorithms that have been discussed in other videos or alluded to, that practical will look at the market, will look at the theoretical, and use a proprietary algorithm to take both into account and come up with a more likely price that you can expect 5 years out. And then when you discount it back, it's the orange line. All right, there are other videos in the valuation calculation playlist that talk about sales growth and things for you to consider when you're on the website in terms of as you move the slider around, things you should be thinking about in terms of moving that slider to impact sales growth. The next video will talk about the profit margin. If you wanted to overwrite the profit margin, we'll be talking about ways to do that. And then PE, future shares growth, cost of capital, and then even the number of years you could indirectly change by modifying the sales growth. As already mentioned, since originally recording this video, you can now explicitly enter the future profit margin and future price earnings multiple through the new sliders that have been added. All right, so we'll get more into this in the subsequent videos, so thanks for watching.